Credit Suisse couldn't calm the market. Now, Credit Suisse Group AG's new chief has asked investors for less than 100 days to deliver a new turnaround strategy. Turbulent markets are making that feel like a long time. The cost of insuring the firm's bond against default climbed about 15% last week to levels not seen since 2009 as the shares touched a new record low. On Friday, Chief Executive Officer Ulrich Körner reassured staff that the bank has strong capital base and liquidity positions and told employees that he will be sending them a regular update until the firm announces a new strategic plan on October 27. The shares dropped as much as 7.8% in early Zurich trading on Monday to a fresh record low of 3.67 francs. Körner, who was named CEO in late July, has had to deal with market speculations, bankers' exit and capital doubt as he seeks to set a path forward for the troubled Swiss bank. The lender is currently finalizing a plan that will likely see sweeping changes to its investment bank and may include cutting thousands of jobs over a number of years, Bloomberg has reported. Körner's memo was the second straight Friday massive speculations over the beleaguered bank's future increases. Analysts at KBW estimated that the firm may need to raise 4 billion Swiss francs of capital even after selling some assets to fund any restructuring, growth effort, and any unknowns. Credit Suisse's market capitalization dropped to around 10 billion Swiss francs, meaning any share sales would be highly dilutive to long-term holders. Now, the market value was above 3 billion francs as recently as March 2021. Credit Suisse's executive have noted that the firm's 13.5% CET1 capital ratio at June 30 was in the middle of the planned range of 13% to 14% for 2022. The firm's 2021 annual report said that its international regulatory minimum ratio was 8%, while Swiss authorities required a higher level of about 10%. The 5-year credit default swaps price of about 250 basis points is up from about 35 basis points at the start of the year and is near their highest on record. While these levels are still far from distress and are part of a broad market sell-off, they signify deteriorating perception of creditworthiness for the scandal-hit bank in the current environment. The KBW analysts were the latest to draw comparison to the crisis of confidence that shook Deutsche Bank AG 6 years ago. Then the German lender was facing broad questions about its strategy, as well as a near-term concern about the cost of settlement and a U.S. probe related to mortgage-backed securities. Deutsche Bank saw its credit default swaps climb, its debt rating downgraded, and some clients stepped back from working with it. The stress eased over several months as the German firm settled for a lower figure than many feared, raised about 8 billion euros of new capital, and announced a strategy revamp. Still, what the bank called a vicious circle of declining revenue and rising funding costs took years to reverse. Now, there are differences between the two situations. Credit Suisse doesn't face any one issue on the scale of Deutsche Bank's $7.2 billion settlement, and its key capital ratio of 13.5% is higher than the 10.8% that the German firm had 6 years ago. Now, the stress Deutsche Bank faced in 2016 resulted in the unusual dynamic where the cost of insuring against losses on the lender's debt for 1 year surpassed that of protection for 5 years. Credit Suisse's 1-year swaps are still significantly cheaper than 5-year ones. Last week, Credit Suisse said it's working on possible asset and business sales as part of its strategic plan, which will be unveiled at the end of October. The bank is exploring deals to sell its securitized products trading unit, is weighing the scale of its Latin American wealth management operation, excluding Brazil, and is considering reviving the first Boston brand name, Bloomberg has reported.